Technical analysis is the study of price movements, through the use of charts, in order to predict future price trends. It is mainly based on the adage, history repeats itself. There is two main notion in technical analysis, and these are, support, and resistance. We have covered them previously in part 1, under what we class as key level. A quick recap on what a support is. It's a virtual line drawn with historical lows. The currency's price doesn't want to fall below this line. When the price hits this level, if there are more buyers than sellers, the price bounces off the support level. But if there are more sellers than buyers, the price falls below the support level, break, and this level can become a resistance level in the future. Resistance. It's a virtual line drawn with historical highs. When the price hits the resistance level, there are potential sellers, people who already sold the currency pair before, that remember the collective power they had to push price lower, and will enter the trade. There are also buyers, who bought the pair at support, and will close their buy positions with sell orders, at or just before price gets to the resistance level. If, altogether, they outnumber the buyers, the price bounces off the level, confirming the resistance level. However, if the new volume is made up of more buyers, the resistance level fails, and the price rises higher than the resistance, break. When this happens, the resistance level can reverse, and become the new support level. Before trading breakout, you need to understand the different type of breakout that can occur in Forex. But first, you need to know that over 4 times out of 5, a key level will hold. That means, that a strategy based on breakout, will miss more than 80% of the potential trades. There is 4 types of breakout. The first one is the clean break. When momentum is so high, that the key level is just smashed through. Usually occurring on very strong key level, that have been holding for quite some time, or when a very strong news has been released. The second type of breakout, the most common one, is when the price break the key level, and retest it shortly after. What is happening, is on the break, there is more buyer than seller. But not a lot more, when this happens, and when buyers start taking profit. Sellers start to outnumber the buyers, and the price retrace. What happened next is, that now you have sellers that might be exiting at break even, got scared by the quick break of key level, or buyers now entering the trade after witnessing a break of previous key level. When this happens, the buyers outnumbers the sellers, and the price goes back up. This is what we call a price retest. And this occurs in the majority of the breakout. The third and fourth type are, when the previous high, or low, was not exactly on key level. Either too low, or too high, a fake out. Those scenarios are the worst to place a trade, because they present the biggest risk. Indeed, the stop loss would be a lot bigger due to the nature of the previous price retest level. One thing to remember is, that unlike any other trade, the breakout actually requires a price confirmation. Meaning that for once, that we wait, usually the second candlestick before to enter the trade. For example, taking a breakout on the 1-hour chart, I would wait closure of my first candlestick above key level, and then will place the trade on the second candlestick opening. The second biggest concept of technical analysis is the trend. Knowing the phases of a trend can help you better evaluate what is happening. There is 3 phases that apply to bull and bear markets. Bull market. Phase number 1, the accumulation phase. This is the start of the upward trend. After the market has been in a decline for an extended period of time, the prices bottom out. This is when the smart money, the pros, enters the market and starts buying at a low price, accumulating and positioning in preparation for the next advance. The start of the phase is marked by a period of price consolidation. The previous downtrend flattens out, as selling pressure starts to dissipate. The prices will then start to move higher, no lower low and high. Phase number 2, the public participation phase. It's the longest lasting of the 3 phases. Most technical analysts begin to participate, prices begin to advance rapidly. As the economy and the related news improve, more and more investors move back in, sending prices higher. This phase can last several years. Historically, there is a bear market on the average of every 3.5 years. Therefore, an advancing bull market should last around 3 years before another bear market begins. And finally, phase number 3, distribution phase. This phase occurs when economic news is better than ever, and when speculative volume and public participation increase. Market tops form after a long advance. During this phase, the pros start selling and unaware traders buy from them, thinking that prices will continue to move higher. The market seems to get tired and stops advancing. It begins moving sideways, no new highs, and then begins to roll over. On a bear market, the 3 phases are: the distribution phase is at the top, and the accumulation phase is at the bottom. It follows a previous uptrend. Distribution phase. In this phase, the overall sentiment is optimistic, unaware traders think that the market is going to make higher highs. But the pros sell their positions, overbought market. The price movement starts to flatten as selling pressure increases. The prices start to fall as more and more traders, anticipating weakness, exit their positions. They fail to make a higher high and low, and a downward trend is then confirmed. Public participation phase. This phase usually doesn't last as long as in a bull market. As the economy and the related news are getting worse, selling increases and buying dries up. Accumulation phase. The pros who sold during the distribution phase start stepping back in as prices are reaching the bottom. They position themselves for the next market advance, bull market, and the cycle repeats itself. Trend versus range. We've seen that the market can be in either an uptrend or a downtrend. But actually, there are not 2 but 3 potential directions to the market, the last one being sideways. For about a third of the time, prices move in a flat, horizontal pattern called trading range or range trading. In this case, the supply and demand are in a relative balance. Most technical tools are trend following and then are not designed to work in a ranging environment. Every trader should be aware of the environment he or she is trading in. There are different ways that traders can use to determine whether a currency pair is range trading or trending. Of course, many people do it visually, but some tools can help. One of the first technical indicator, and one that is actually very much underestimated, is the volume. Volume is an important factor in confirming price signals. Volume should increase in the direction of the major trend. In an uptrend, volume would increase as prices move higher, and decrease as prices fall. In a downtrend, volume should increase as prices drops, and decrease as prices rally. Volume must confirm the trend. Another great indicator, that is not really one, is the currency strength. It is only possible on the platform I use, CTrader. By simply typing the currency such as GBP for pound, I can see in no time, what is its strength against all other counter currency on the market today. That is a quick way of finding the best potential pairs, for example a fundamental trade. Remember, buy scenario against a weak counter currency, sell scenario against a strong one. Well, this is how you can do it, in less than 2 minutes. ADX, Accumulation Distribution Index. Used to determine the strength of a trend. If ADX superior than 25, a trend has developed, the greater the number, the stronger the trend. If ADX inferior than 25, the currency pair's trend is weak. Remember, trend, general direction of the market or of the price of an asset, can vary from short to intermediate, to long term. Range, difference between the low and high prices for a currency over a specific time period, day, year. The more volatile the currency, the wider the range. The ADX is so popular, because determining whether a currency market is trending, or not trending can help a trader avoid the pitfalls of some indicators. Moving averages, and their variance are effective during trending markets. However, during consolidation periods when prices go up and down, but in no direction, moving average indicators have a tendency to give numerous false buy and sell signals that can add up to trading losses. During trending markets, it is suggested to use moving averages, trend lines, and other trend-following technical indicators. Oscillators can be effective in non-trending markets. Buying low and selling high is accomplished quite readily with oscillators in a non-trending market. Unfortunately, during trending markets, oscillators perform quite poorly, often selling short during a bull market run, or buying during a bear market downtrend, adding up to large losses. For periods of non-trending, oscillators like stochastic, or RSI and other range-bound indicators like Bollinger Bands could be used. That is why, the first tool you can use, if struggling with determining a trend, is the ADX. ADX can, for example, be great for trading a breakout. A breakout is likely to occur on a strong momentum, therefore on a strong ADX. Other use of the ADX. One we have not mentioned before. ADX can be used to spot divergence. Divergence are not useful in providing you with a buy or sell signal, but rather a good way of telling you when to tighten stop loss, or take partial to full profit. The following divergence is called a negative divergence. Price is making higher highs, when ADX is making lower highs. This is indicating that the trend momentum is weakening, and might maybe lead to a range or reversal. So to summarize, strategic use of the ADX in trading. Always read price first, it is the most relevant tool on a chart, and then read ADX in the context of what price is doing. When any indicator is used, it should always add something that price alone cannot easily tell us. For example, the best trends rise out of periods of price range or consolidation. Breakouts from a range occur when there is a disagreement between the buyers and sellers on price, which tips the balance of supply and demand. Whether it is more buyer than sellers, or whether it is more seller than buyers, it is the difference that creates price momentum. Breakout are not hard to spot, but they often fail to progress and can end up being a trap. But ADX tells you when breakouts are valid, by showing when ADX is strong enough for price to trend after the breakout. When ADX rises from below 20 to above 25, price is strong enough to continue in the direction of the breakout, leading the trader to have a chance at buying, or selling this breakout with success. RSI, Relative Strength Index. It's a momentum indicator that compares the magnitude of recent gains and losses over a specified time period to measure speed and change of price movements. It is used to attempt to identify overbought or oversold conditions of an asset. Ranges from 0 to 100. The RSI provides a relative evaluation of the strength of a currency's recent price performance, thus making it a momentum indicator. Momentum, rate at which a currency's price is increasing or decreasing. The default time frame for comparing up periods to down periods is 14, as in 14 trading days for daily chart. Two methods to interpret the RSI. Overbought or oversold. RSI superior than 70 is considered overbought, may be primed for a trend reversal or corrective pullback. It is a sell signal. RSI inferior than 30 is considered oversold, may signal a trend change or corrective price reversal to the upside. It is a buy signal. Divergence. Bullish divergence occurs when the currency makes a lower low, and RSI forms a higher low. RSI does not confirm the lower low, and this shows strengthening momentum. Bearish divergence forms when the currency records a higher high, and RSI forms a lower high. RSI does not confirm the new high, and this shows weakening momentum. In this example, we have the two use of the RSI. The first use is made on this double bottom here. On the first test of this key level, we are struggling to establish if price bounce or break the key level. The RSI is not oversold. The price makes a fake out and bounce off the key level, but does not go very far before retesting the key level again. Based on the previous low made, one could look at possibility of making a lower low, therefore a successful breakout, or bounce back from the same level. Quickly looking at the RSI, there is a bullish divergence on the way. Indeed, the RSI is making higher highs when our price is flat. This might be the sign of an early reversal, therefore could confirm your initial buy from key level. On the second use, we are approaching a key level. First, we can see we have broken the previous key level followed by a retest. So likelihood of breaking another key level is poorer. On top of that, my RSI is overbought, superior than 70. I therefore can attempt the sell from my known key level. Stochastics. The stochastic oscillator is a momentum indicator that measures the current currency price compared to its historical price for a given time period. It measures the degree by which a currency is overbought or oversold. Scale, 0 to 100. Very similar to RSI, it is slightly different in the way it works. Stochastics above 80 is overbought conditions, the currency is strong, and the price is closing near the high of the trading range. Stochastics below 20 is oversold conditions, the currency is weak, and is closing near the low of the trading range. Two methods to interpret the stochastics. Overbought and oversold and divergence. It occurs when the stochastics values are moving in one direction, and the price values are moving in the opposite direction. Indicates a possible trend reversal. For the stochastic to work best, we are looking at cores SOV that occur either above 80, or below the 20. You can find all the buy and sell signals highlighted in blue arrows. As usual, it is best to find the opportunities first, by having your key level and or trend lines drawn up. Looking at the same chart than before with our RSI, our short from previously is this time not signaled. But the stochastic is making lower highs, and the price making higher highs. This is a divergence that might lead to a reversal. This can be explained by the key level. Moving averages. Probably the most used tech indicator, or at least one of the most useful one for us. Calculated by averaging the closing prices for a given time period. Every day, the latest price is added, and the oldest price is dropped to make that day's calculation. The average for each day is then plotted against the price chart, to show how the trend is changing over time on a daily chart. SMA, Simple Moving Average. Formed by finding the average price of a currency over a set number of periods. The simple moving average is arguably the most popular technical analysis tool used by traders. The simple moving average, SMA, is often used to identify trend direction, but can be used to generate potential buy and sell signals. The SMA is an average. An example of a simple moving average is presented below. The prices for the last 5 days were 114, 115, 115, 114, 115. The average would be 114, 115, 115, 114, 115 divided by 5 days equal 114.6. Therefore, the SMA line below the last day's price of 115 would be 114.6. In this case, since prices are generally moving higher, the SMA line of 114.6 could be acting as support. EMA, Exponential Moving Average, puts more weight on recent prices. It reacts quicker to recent price changes than SMA. Therefore it is more prone to false signals. This is what a buy can look like, using a combination of EMA crossover on trend line. Usually I like to have 3 elements of support. But I will often act on a trend line crossover with EMA, if the trend is good. So as soon as I see the EMA, going toward my trend line, I am preparing for a buy. Remember, the earlier the buy, the lower the risk. If acting on a 4-hour chart, I would allow myself 20 to 30 pips drop from the crossover, before considering it failed. So always make sure the target is worth it. And do not wait for the bounce to appear, this will only limit the gains, and increase the risk. MACD, or Moving Average Convergence Divergence. It's a momentum indicator, that can be used to confirm trends while also indicating reversals, or overbought oversold conditions. It is calculated by subtracting the X period of time EMA, from the Y period of time EMA. Z, usually 9, EMA of the MACD is called, the signal line. It is then plotted on top of the MACD, functioning as a trigger for buy and sell signals. 3 methods to interpret the MACD. Crossovers. Sell signal when the MACD falls below the signal line. Buy signal when the MACD rallies above the signal line. Overbought oversold. When the shorter MA moves away significantly from the longer MA, it is likely that the currency prices movements are starting to exhaust, and will soon return to more realistic levels divergence. When the MACD diverges from the trend of the currency price, this may signal a trend reversal. If the MACD makes a new low, while the currency pair does not also make a new low, this is a bearish divergence, indicating a possible oversold condition. If the MACD is making new highs, while the currency fails to confirm these highs, this is a bullish divergence, indicating a possible overbought condition. The MACD is a brilliant indicator, as it can do it all at once. Providing signals, for a sell like here, and for a buy like here. But also, showing you overbought conditions like here, and oversold conditions like here. Right, there are the best setting I found for the MACD. They tempt to be a lot more closer to the price action. This is the last way of using the MACD. Using it to spot divergence. Like in THI's example, the price is attempting lower lows on key level. But my MACD is making higher lows, meaning a gain of momentum. This could be an extra info to buy the key level, especially if it had multiple crossover. Bollinger Bands. I will cover the bands, so that you never use them. It can only be good at spotting volatility, which honestly any trained eye could easily see. The bands are plotted at 2 standard deviations above or below the moving average. Because standard deviation is a measure of volatility, when the markets become more volatile, the bands widen. During less volatile periods, the bands contract. Typically used to detect extreme unsustainable price moves, capture changes in trend, identify support resistance levels, and spot contractions expansions in volatility. Breakout. When the prices break above or below the upper or lower band, it is an indicator that a breakout is occurring. Overbought, oversold. When the price closes above the top band, traders will sell, assuming that the currency pair is overbought, and will want to revert back to the middle MA band. When the price closes below bottom band, traders will buy the currency pair, assuming that it is oversold, and will rally back towards the top of the band. If you look closely at this example, it is typical use of bands. It will work half of the time, and not the other half. And that makes it the perfect tool for broker. Why is that? Well, if you consider that a tool will likely make you win as much as you lose. First, you will feel the need to keep trying. Second, you are unlikely to be unhappy with it. But ultimately, all your trades will be commissioned, and the only winner will be the broker. Hence why, this is one of the most developed and advertised strategy on internet, webinar, and other free educators. Sometime even paying one. Here at the cartel, we have zero use for this one. Fibonacci. Arguably the most heavily used tool is the Fibonacci retracement. To calculate the Fibonacci retracement levels, a significant low to a significant high should be found. From there, prices should retrace the initial difference by a ratio of the Fibonacci sequence. Fibonacci retracements use horizontal lines to indicate areas of support and resistance. Those ratios seem to play an important role in the market, and can be used to determine critical points that cause a currency's price to reverse. The direction of the prior trend is likely to continue, once the price of the currency has retraced to one of the ratios listed above. Fibonacci sequence is series of numbers that seems to consistently occur in nature. From the sequence come a series of ratios, and it is these ratios that have special significance to traders. First, we need to understand what a significant price move is. One information that most traders are unaware of is the most relevant key level in Fibonacci. And that is not coming from trading, but it is coming from Mother Nature, and the most relevant ratio is 38%. It is the most predominant ratio in nature, and therefore makes it the strongest one in trading. That said, how do we proceed to find a relevant candidate for a Fibonacci retracement? In other words, what is a significant price move? A significant price move is often made from a trend reversal, and/or a heavy fundamental. For example, what would be for UK one of the most significant price move witnessed in recent year? If it has to do with trend reversal, or heavy fundamental. What could that be? Of course, Brexit. Brexit vote would make a perfect starting point for a Fibonacci retracement. But where do you stop? That's where the 38% comes into play. Looking at my chart here, my price is making a reversal from here. Keep in mind that it can sometime be purely technical, meaning any reversal area like this could be a good starting point. I would start plotting my Fibo from A to B. This would give me a series of potential key level like these. I would stop at the first reversal like B to C. But where most traders fail, is that as long as this price move does not retrace more than 38% key level, we will consider this price movement to still be significant. To put it simply, a price move that does not retrace more than 38% is still considered significant, and so, Fibo can still be amended to the new highs made. That means that if, from 38% we are making new highs like this, we can update our Fibonacci to the new high, and so have one now from A to D. This process is possible, as long as we never retrace more than 38%. By the way, this is slide 38, how random. What happened when the price retrace more than 38% like in this example? The first thing to understand is that this Fibonacci is not invalid. It has just been identified as the longest retracement you can measure, because the price if making higher high, would not be the most significant anymore. So, as long as we are trading within those ratio, we have use of this Fibo. But, when price make a new high, like here from the 61%, which we will see later in part 4, is the second most significant key level. We cannot amend the Fibo like this. And a new Fibonacci should be made from C to D. Commodity Channel Index. It is a great indicator of momentum. It is designed to identify cyclical turns in currencies. It quantifies the relationship between the asset's price, a moving average of the asset's price, and normal deviations from the average. Focus on movements above plus 100, and below minus 100 to generate buy and sell signals. If CCI moves above plus 100, the currency enters into a strong uptrend, it is buy signal. If CCI moves below minus 100, the currency is in a strong downtrend, it is sell signal. This is a brilliant indicator, in combination of MACD. Because, if you use it to confirm MACD signals, instead of buy and sell signals, this would generate a greater accuracy. For example, in gold daily chart, this, combined with MACD, has almost 100% accuracy. What the CCI looks like on chart. Every time this cross above any of the two line, this is considered as a buy signal. Every time it crosses below, this is considered as a sell signal. Finally, the parabolic SAR, used to predict a currency future direction, can also be used to determine where stop orders should be placed. Series of dots placed either above or below an asset's price on a chart. A dot placed below the price is deemed to be a bullish signal, causing traders to expect the momentum to remain in the upward direction. A dot placed above the prices is used to illustrate that the bears are in control, and that the momentum is likely to remain downward. Transaction signals are generated when the position of the dots reverses direction, and is placed on the opposite side of the price as it was earlier. Many traders will choose to place their stop-loss orders at the SAR value, because a move beyond this will signal a reversal, causing the trader to anticipate a move in the opposite direction. I personally found the use of SAR to be more focused on where the trend momentum is at. Personally, one of the use I recently found for the SAR, other than helping with direction of momentum, is that on 15 minutes GJ chart, when price action touches the SAR, it usually follows a reversal.